Inflation update and relative to the business cycles. I'm Rich Positive for Critical Point, 9:12 a.m. Eastern Time, March 29th. Okay, the financial markets are closed today, and some of the commodities are closed. I was thinking some might actually trade and close early, but so far I haven't seen evidence of that. But we got the inflation report because the government is open today and banks apparently open today, but apparently like exchange traded financial products are not open. All right, here we go. The report came in and I really like it. The modeling really likes it. And the pollsters were darn accurate for a change. Came in with headline inflation at 2.5% annualized as of February, and the trade was expecting that. The month-to-month came in at 0.3% when they were expecting 0.4%, so a bit better than what they expected. And then on the core, we find that it was I think 2.8% annualized. No, maybe it was I think it was much higher than that, but it was in line. It's in a downtrend from what we've done the prior 3 years here. And they actually nailed that number. And then the month-to-month was also 0.3%, but that's what they also forecast. So they nailed that one. So they nailed about everything that one could do in this kind of a report. So the conclusion is that, yes, the trend is down for inflation. This is the annualized chart here showing monthly updates of inflation, and there it is, ticking down by this month. The trend is still down. We're winning on inflation. We're getting closer to the 2% target by the Fed Reserve, and the Fed Reserve prefers PCE over the CPI inflation, so at 2.5%, they got to be feeling pretty good about this, getting close to their 2% target. And frankly, I think in their own circle, they're not going to tell us this, but I think they're fine with this 2.5 right now. I don't think they feel like they got to work harder and harder to try to get it to 2%. So I would say from this inflation report, they can lower interest rates. Problem is, when you look at the jobs and how strong it is, you look how strong the economy is, and if anything, it's going to grow even at a faster pace. And we did get the fourth quarter, I think it was, second revision annualizing was now I forgot the number. It seems like it was 3.1, 3.4, somewhere in that area. A good economic growth number. So the point is, the Federal Reserve is still probably going to think, let's just stay on hold. Our high interest rates aren't hurting the economy. It's hurting some. It's hurting some businesses. It's hurt some banks. Last year we had a little banking crisis there. A few banks had to be bailed out, and there's still one of them going through a process here early this year for it. But in general, I think the Federal Reserve is saying, on balance, it's not hurting the country. And they're also saying, well, if it's not hurting the country, it's also not slowing the economy down. And maybe they're thinking they just need to be cautious. You know, they're probably still going to lower interest rates in June, but we might be surprised later, and that may upset the stock market later. But right today, I think the stock market is going to like this report. I think it's even better than the CPI inflation report that we got a few weeks ago. And again, this is inflation as of February. Okay, now model analysis. A major long-term bottom in inflation, but it was also a super cycle bottom for inflation and interest rates. Okay, and this was back in 2020. When the super cycle for the stock market actually bottomed back in the great financial crisis in 2009, and a super cycle for the economy bottomed 2009. So the bond market and inflation kind of went off on their own thing. And the inflation probably would not have gone below 2009, except that we got struck with the COVID, and it was just a wild, wild west show. It was crazy. It was chaotic. And we shut down the economy, and we could have caused a depression right then and there. But we printed money, we got the money out there, we kept the system afloat, and in the end, the economy was really just had a normal recession. The stock market had a normal 35% drop, just normal, okay? Even though there's some data, such as this inflation, was saying, oh my gosh, it was worse than 2008, 2009. But when you put all the pieces of the puzzle together, we saved ourselves from what would have been a depression. And it wasn't supposed to occur relative to the super cycles of the economy and stock market. And turns out it did not occur. We saved ourselves from it, from our system of being able to print money, move money around quickly, keep the show going, okay? Now, of course, some of this money printing caused a spike of inflation, and we had businesses that became very greedy and made more profits. They had already been making profits, but because their costs went up, they said, oh, we need to get that money back too to keep our profits up there. But what they didn't say was they added even more profit. So it was a triple profit. It's like 3 scoops of ice cream for your ice cream cone. They did a bad thing. They were capitalists trying to destroy capitalism, whether they knew it or not. And now we're starting a brand new revolution of going after that. We're going to change capitalism in the next few decades to try to stop that. And it's probably a good thing because it'll help temper inflation in the next few decades. But that also may help temper that we don't have to raise interest rates because it's really not a good tool, in my opinion, okay? And I think there's more waking up on that. So that's the story, what took place from 2020, the big drop, and then the explosion in inflation in 2021, which on this chart, most people ignored that. The real inflation was in 2022, okay? They wiped this out saying this is just fuzzy numbers, this is just fuzzy numbers, this is where we're really at, and it's still way too high, and then we had the war on inflation, and it worked, but the Fed did make an impact. But they did it psychologically by raising interest rates and scaring most of us to try to help fight inflation, but they didn't do it on their own. You and I were already starting to fight that inflation, maybe just a little ahead of the Fed, and then the Fed just added more to it to help knock it down. But right today, you and I are doing this, of lowering this inflation back. Now, I also am fine with the Fed not lowering interest rates for years to come. We're actually at average interest rates, and we're now back to average inflation, going back 100 years or more. We're at average GDP probably, or something like that. So we're really just back to normal. Things are running hunky-dory, and the economy is doing quite well. But there are going to be concerns of rising inflation, and on a short-term basis, I do see an uptick in inflation this summer. I don't think it's going to be significant. On a minor long-term business cycle, it probably bottomed in 2023 for the latest, blipped its head up into late 2023 for a minor long-term. This is a warning that minor long-terms and mid-sized long-term business cycles, and maybe even the decade-long business cycle, can create higher inflation late this decade. And if it gets close enough to when we're due for that once a decade sell signal in the stock market and a bet against the economy, it may be the Federal Reserve will raise interest rates, but at that time, they won't be able to have a soft landing. They will break the machine, and down comes the economy. Down comes inflation, down comes interest rates, and the economy comes down, stock market comes down, okay? We cool everything off, and then we're just going to print money and rebuild for next decade, start the whole cycle all over again, wash, rinse, repeat, okay? But in the meantime, there is a chance inflation is going to work lower into 2025, as I've been forecasting, as others have been forecasting, and you could say if you look at the dot map for the Federal Reserve, they assume it's still going lower too. But I also think we're seeing there may be a real struggle now to get inflation down to 2%, okay? Now, this is the month-to-month inflation, and this is, you may have noticed on the other chart, I had an ellipse drawn there over the prior decade, and what it's basically saying is we're normal on an annualized basis. Well, this chart, we can also go back into the 2000s, and this is the normal month-to-month, and look at this. We're calming inflation down. It's turning quiet, less volatile, less crazy, and it's in the range. I think the stock market's doing the correct thing and trying its best to ignore inflation, ignore the Federal Reserve, pull back on watching interest rates. It will always have to watch interest rates. There's definitely models that incorporate that in the stock market. And if they have nothing better to do any given day, they'll probably trade along with interest rates or even trade opposite of interest rates, the bond market, okay? That's fine. That's normal behavior. But we have been getting very excited over interest rates, and now that's probably going away. Why are we doing this? Because the economy is getting back to normal. And what is the economy doing at normal? It's growing. And if anything, it's actually going to grow a little better going this year on into the next couple of years. So that's encouraging people to be long-term bullish the stock market, and that's why you've seen such a huge run-up in the stock market. is they finally woke up that all these people the past 2 years preaching an end to world story, 1929 stock crash, we're going into recession, woe is us, they were so far wrong, and some of them very famous, some of them with very good track records, all right, some of them with some very good research, but they were just flat out wrong. And we took the stock market way too low in 2022. It was not necessary, all right, but it did help with the psychology to scare businesses in, being careful what they were charging consumers, what we're paying to try to bring down inflation. So you could still argue it helped, but we really didn't have to get that crazy. We're now just waking up to all of that. We're really getting where we should have been all along last year and somewhat the year before. But now we're adding AI for this decade story. You get a story every decade of something new and exciting that helps the economy and business and helps the stock market. And AI is it, okay? And if you don't get something very exciting, you're going to get not such a good decade. And there's examples of that, okay? So at any rate, I really love this PCE inflation report. The economy is working the way we anticipated. The reason I was right is I recognize this decade-long juggler business cycle that has worked for the history of this country. I think it's worked over in England and a few European countries going back a couple hundred years even. Okay, and it gives us a gauge, and we're only about 40% along the way of that economic growth. It's simply not the right time to be betting on the downside of the stock market. It's not the right time to bet against the economy. It's not the right time to bet against American people. That's the bottom line. And now we can just see all the Bidenomics trickling in here. It's just, we're rolling. We're rocking and rolling. This is the roaring 1920s. This is the raving 1990s. And it's even a lot like 2021. Okay? And yet the crazy thing is, we have less Federal Reserve money printing boosting the economy. Where everybody complained in 2021, they've been complaining for 20 years, oh, the Federal Reserve makes the stock market way too high because they pump too much money. And now we're getting evidence that we're doing just as good, if not better, than some of those years. And the Fed didn't really pump the money. Now, they have done some few things there trickling in. They're helping. You can see, even though they haven't lowered interest rates, they're doing a few things now to help out, help put the brakes on. And they are eventually going to get back to normal, lowering those interest rates. But I don't think they're going to be aggressive money printers and stimulators of this economy for quite some time now. I think they've got a better handle on this whole business cycle thing, and they are respecting the idea the economy is growing quite well on its own. They're winning the war on inflation, but at the same time, I don't think they're going to help out by lowering interest rates very soon. And when they do start, I think there could be sporadic and very small reductions, and I don't particularly care. I love this inflation report. Things are going good. Got to stay bullish and optimistic. The economy in the U.S. stock market. Past results are not necessarily indicative of future results. Have a great day. Thank you.